Hello all, good evening. So welcome to another learning session on the economic indicators. So in this video, we will discuss about the impact of PMI data, more specifically the impact of it on the bonds and the stocks, and some deeper understanding of the broad PMI levels. So in the last video on PMI, we discussed about the basics of PMI in terms of its definition, the data collection, and the broader interpretation. So in this video, we'll go a bit more detailed and try to analyze the broader impact of it, like the specific impact of it on the bonds and the stock market in general. So we know that above 50 PMI is expansionary in nature, and below 50 is contractionary in nature, right? So let us just try to revise that basic thing. So above 50, if the PMI reading is above 50, or take PMI for manufacturing, for example, we know that there's an expansion in manufacturing. Now, PMI is not only a handy tool for the manufacturing, but also the overall economy, right? So when the PMI reading is above 50, it indicates a general expansion in the economy, right? So overall, above 50 is a good condition. There is expansionary tendencies in the economy, with both manufacturing as well as the economy growing. So this is about the first interpretation of PMI above 50. Now consider what happens when the PMI is somewhere like it is above 40 and in this particular range. So whenever we know that PMI slips below 50, it is a contraction in manufacturing, right? So there is a contraction in manufacturing, but just think of it, manufacturing is not the only sector in the economy, right? So despite manufacturing downturn, the broader economy might still be growing. So there's no need for any kind of panic to set in when the PMI slips below 50. It's only that the manufacturing is contracted, but still the economy broadly might still be growing. So that is the assumption in the second stage, and this is the stage for a kind of caution that where the economy in the future might head towards, right? Either it can again go back to its expansionary stage or slip into the recessionary stage. So this is the second one where the PMI is between 40 and 50, and think of the third scenario, right? Third scenario is like when the PMI even drops below 40 levels. So and it sustains there. So of course we know that below 40, below 50 itself the manufacturing starts contracting, but below 40 it's like the manufacturing and the overall economy has slipped into a kind of a likely recessionary tendencies, because it is like a deep contraction scenario. And not only the contraction, just think of it from a policymaker's perspective also, that what could be the potential response from the Federal Reserve, like any central banks, if you consider, they will start thinking of lowering the interest rates. If the interest rates are high, they will start thinking of cutting the interest rates so that this can spur the economic activity and manufacturing in a specific. So a prolonged reading of the PMI below 40 signals some significant distress, right? So because of this distress, there can be a monetary policy stimulus in terms of cutting the interest rates, and parallelly there can be fiscal stimulus also. So this is the deep dive meaning of the PMI when it comes to the economy and things like that. But when we look at the just trend of the PMI, this is the manufacturing PMI of US. We've seen here that this particular reading of PMI during the COVID period, it slipped below. You can see here that it slipped below 40 only in this particular point of time, right? It was because of the lockdown thing, because of the COVID scenario. But post this, it's again started to jump back, and it gained full steam, and it was back to its expansionary mode above 50, and it continued. And currently, if you see, the PMI is somewhere hovering around 50 to 45 range. This is the manufacturing thing. Again, indicating that yes, there is a growing tendency in the economy, and there's not much contraction taking place. And one thing what we must always observe is the trend also, right? Why is the PMI trend currently down? It's because of the interest rate cycle, because in this particular period the Fed is actually increasing the interest rate. So when the interest rates keep on increasing, it becomes difficult for the corporates to get the borrowing, right? The borrowing at a very less cost. So what is happening when the interest rate is increasing, the borrowing cost is increasing, which will kind of affect the profitability of the firms. So overall, but still, the point is the PMI being around 50 is still a good sign for the economy in general. And when you look at the services PMI is also, you can say, sustaining above 50 range. So when you look at the latest PMI reading on November 3rd, it was this is for PMI of services, it is 50.6. Again, there's an expansionary tendency. So once the PMI data is strong, so the means the economy is strong and there is no need for panic to set in. So that is why these indicators are leading indicators, and you can obviously see here that the importance is 3-star, which has very high market sensitivity PMI data. So moving on, now we know the broad PMI values and how to interpret this. So let us try to apply them to the specific scenarios, right? Just summarizing again the key takeaways. So when we know that the ISM manufacturing survey, again, which gives out the PMI report, it's critical to assess the health of the economy broadly. We understood through the key values, and then looking at the decision making. So these indicators are used by policymakers, investors, and businesses to make informed decisions about the overall state of the economy. Right? We again discuss what the Fed can possibly do when such scenarios, and when there is a sustained low score, like for example something like below 40 or below 45, this can significantly influence the Federal Reserve to adjust the interest rate. In this case, to cut the interest rate if that case happens to stimulate the economy. So the broader interpretation. Now moving on to the specific impact of the PMI on the bonds and the stocks. So first, when we look at the bond market reactions, when we look at the PMI above 50, we know that the economy is growing, right? So when the economy is growing, there is a risk on sentiment. So bonds, which are generally a risk, it's a safe haven kind of instruments, they take a backseat. So that's why it's bearish for fixed income instruments like the bonds. And when it is below 45 to 50, again, it's a kind of indecision state, so it will have minimal impact on the bond market. And below 45, when it happens below 45, we know that the economy is kind of contracting. Below 40, you can consider. It's very rarely that we have seen in the recent past it has gone below 45, except the COVID scenario. But the point is, when it is below 45, there is a decline in manufacturing, decline in economy. So what will happen? There is a kind of pessimism in the overall economic sentiment. So that is why the safe haven instruments like the bonds, bond market generally tends to go up. So that the implication is that there's a significant weakness in manufacturing and potential broader economy. So the money flow happens towards the bond market and less towards the risky assets such as the stock markets and risky assets of stock market, right? So moving on to the next impact of the on the stock market, right? So when you look at the PMI reading for the stock market, so assume that there is a period of slowdown, right? The economy is falling, and once the economy is falling and the PMI starts to increase, right? This is what a typical COVID scenario, which we are taking as a hypothesis. So the stock market typically reacts positively in this scenario, and because the economy is coming back, it's like a V-shaped recovery taking place. There's uptick in manufacturing and economic activity. So because of this, there is a increased corporate earnings and investor confidence, and accordingly, the share prices of all the companies' stocks, increase. So this is the first case, and this is what happened in one sense during the post-COVID period. And the second one is also interesting to understand, because assume that PMI jumps, during a period of already high business activity. So let me share one example here. So something like this period. So when the PMI is already at its high, the second scenario is PMI being already at a particular peak. So you can see here that this is the 50 range, and the PMI is significantly above 50. So that is the second scenario where the PMI, the economy has expanded a lot in a very short span of time, right? So this is in a way called the overheating of economy, as we discuss. So the PMI jumps during the period of already high business activity. So market response is there can be a potential drop in stock prices. Why? Because once the economy is already overheated, right, there's the potential for it to grow further at the same pace, generally drops. So you can see here that in this particular period, this is approximately, from the June 2021, post June 2021, we saw the drop in PMI to take place, and accordingly, you can see here that the S&P 500, this is the weekly chart of S&P 500. S&P 500 started to show some kind of weakness around this is that particular period, and just it hit another high, and then it started to go for a deep correction. So minor correction, you can see. So this is what happened when the PMI is already overheated. There's no more scope for the economy to grow at such rapid pace. So the economy tends to correct. So this is the second scenario, which was clearly indicating by the data that there is a overheating risk. The high economic activity can lead to inflationary pressures, and because of this scenario, the inflation was at its peak at that particular point of time, and the Fed was also increasing the interest rate. So this we know now what are the policy actions which were taken by the US Federal Reserve at that particular point of time. So Federal Reserve's actions were at this particular point of time to raise interest rates so that they can slow down the economy, because economy growing at such rapid pace leads to inflationary concerns. So higher interest rates, can dampen the corporate profits and investor sentiment, and for equities, and leading to drop in stock prices, which we saw in this overall period, right? So this was that particular period to have that understanding. So no, when we know that PMI is already overrated, nobody should try to enter the market at this particular time aggressively long. Of course, long-term investors can anyway keep doing SIPs, but aggressively being long at this particular point of time is not prudent. So that is what the simple reading of PMI data is helping us to understand. So this is the specific impact of the PMI on the bonds and stocks. Yeah, that's it for this PMI video discussing the impact of it on the bonds and stocks. So let's discuss the next economic indicator in the upcoming videos. Hope it was beneficial. Thank you.